It is officially done. For years, we only theorized about this moment. We analyzed the charts, argued leverage, and warned that banks would eventually get trapped by their own rigged paper games. The shorts had to fail. It was just probability before. Now, it is absolute proof. Quit the guessing games. The dead body has been located. While stackers eyed silver surging on screens, something far more serious occurred unseen. Not on TV, not in headlines, deep in the financial system's raw pressure point. In quiet hours after Christmas, with markets thin and focus low, a weird number hit a Federal Reserve report. That number was not routine at all. It was an admission of guilt. Over $17 billion was yanked from the Federal Reserve emergency liquidity window in just one morning. Strong banks don't go there. This is the financial emergency room. You only show up here when something is totally breaking. Ask why institutions claiming to run global markets needed billions in overnight cash at dawn right after a holiday. Not for growth, not for operations, but because a position moved violently against them and a margin call hit that their balance sheets could not absorb at all. This is where theory stops and math takes over. When prices move fast enough, the accounting tricks fail. Unrealized losses become immediate cash demands. The system doesn't care about your narratives. It only cares about real collateral. That $17 billion wasn't support. It was a tourniquet, a final attempt to stop the bleed before forced liquidations ripped the market apart. And timing matters here. Crises get buried on Fridays because silence hides the fear. This wasn't about the silver price. It was purely about solvency. And this is just the very beginning. If this intro has you thinking differently about what went down, ensure you subscribe to the channel so you don't miss what is next. Comment 1 below if you are ready for Chapter 2, where we link this margin call to the silver explosion and explain why everything just changed. Connect the timing now because markets do not move like this by accident. The same morning banks rushed to the Federal Reserve for emergency cash, silver didn't drift higher. It exploded. It moved fast enough to break assumptions that the system depends on. This was barely a coincidence. It was pure cause and effect. The institutions at the center of this were trapped in massive short positions built over years. Those trades worked only as long as volatility stayed low and liquidity stayed abundant. Both disappeared all at once. In futures markets, losses are immediate. Every dollar move against a leveraged position boosts risk in real time. And when price moves far enough, the clearing system will not negotiate. It demands hard cash. That demand finally arrived. Silver crossed internal risk thresholds banks rely on to stay solvent. Models failed. Value-at-risk assumptions broke down. What was labeled temporary instantly became existential. This is where unrealized losses turn into real survival problems. When the margin call hit, banks checked their cash and found a gap. Liquidity was totally gone. Selling assets would worsen the situation, and buying back shorts in a rising market would accelerate the damage. So they ran to the only place left open. They pledged what collateral they had and tapped the Federal Reserve emergency facility, not to profit, not to stabilize markets, but to avoid immediate liquidation. That cash was not about winning. It was about staying alive just one more day. This is why the repo spike matters. It was not precautionary. It was reactive. It was the financial equivalent of grabbing pure oxygen as the fire spread. And here is the real turning point. When institutions stop controlling price and start responding to it, the balance of power shifts. The suppressors lose control. The market takes it back. That shift marks the transition from managed markets to raw survival markets. And once that line is crossed, there is no easy way back now. This is where most people misunderstand what just happened. They hear the word repo and assume it was routine plumbing, a temporary cash shuffle, a technical adjustment that would quietly resolve itself. That interpretation misses the signal entirely. Liquidity problems do happen in healthy systems. Solvency fears appear only when trust breaks. If these banks were truly sound, they would have borrowed from each other. That is how the system is designed to work. Interbank lending exists so strong institutions never need to touch the Federal Reserve emergency window. Going straight to the Fed is not neutral. It is a public admission that peers no longer trust your whole balance sheet. That distinction is absolutely critical. When banks bypass the market, and run directly to the central bank, it tells you two things at once. They need cash immediately and no one else is willing to lend it. That combination defines stress, not convenience. And it is how confidence evaporates fast. Silver's surge didn't just create losses, it exposed leverage that could no longer be financed. Positions that looked manageable on paper collapsed when marked to market. Collateral values fell while obligations remained fixed, and the gap had to be filled with cash. That cash was simply not there. So the Fed stepped in not as a facilitator but as lender of last resort. That is not stabilization, that is life support, and institutions on life support do not dictate markets. They react to them defensively and under intense pressure. This is why the tone of the silver market is changing. The players that once capped rallies are now constrained. Their balance sheets are damaged. Their risk tolerance is gone. Suppression requires confidence, and that confidence has cracked. This was not just a funding hiccup. It was a structural system warning. And once markets sense weakness at the core, they do not slow down at all. They start to accelerate. Here is the shift most people still haven't fully grasped. This crisis did not stay confined to spreadsheets and terminals. It didn't remain a paper problem. It crossed a line. And once that line is crossed, markets behave very differently indeed. Paper markets fail very quietly. Physical markets fail so loudly. For years, banks could manage price through leverage. They sold contracts instead of metal, promises instead of ounces, as long as most participants treated silver as a trade, not as a necessity that system held. Losses could be rolled, positions could be extended, delivery could be deferred now. That entire dynamic has fundamentally shifted. When spot rips and confidence breaks, the ask shifts from price to, can you deliver? That question is fatal to a paper-heavy rig, because delivery is binary. You either hold the physical metal or you hold zero. As silver mooned, a strange thing happened. Contracts weren't rolled over. They weren't settled in fiat. They stood for delivery. That action speaks volumes. It signals buyers don't trust paper promises anymore. They want the real asset, not the cash payout. Here, the bullion banks face a unique threat. Cash can be borrowed. Liquidity can be printed, but physical metal cannot be forged on demand. When delivery demand spikes, every naked short becomes a ticking time bomb. And time bombs simply do not negotiate. That is why the repo bailout never solved the real problem. It only addressed the fiat side. It did nothing to increase physical supply. Actually, it worsened the situation by confirming that paper claims are unsafe. When a market moves from trading paper to demanding delivery, power flips. Sellers lose control, stackers gain leverage. Volatility spikes not from speculation but due to pure physical scarcity. This is how the manipulation ends, not with a headline, not with a decree, but with silence from the sellers and panic from the buyers. At that stage, the spot price is no longer a debate. It turns into a pure rationing mechanism. And when a strategic metal hits that phase, history guarantees only one result: a massive revaluation. This is the paradox at the core of what we see. The fix meant to stabilize the system is actively speeding up the forces breaking it. The $17 billion print didn't restore trust. It exposed deep fragility. Just take a look at the mechanics. Banks needed liquidity because silver was spiking against the dollar. That move signaled stress. The Fed's reply was to print more fiat. But printing bills to fight a rising hard asset doesn't fix the imbalance. It amplifies it. Every new dollar pumped into the system dilutes the existing supply. That dilution drives investors towards scarce assets, which pushes prices up, which deepens the losses on the naked shorts the bailout tried to protect. This is a classic feedback loop. The higher silver climbs, the more aid banks need. The more bailouts they get, the weaker the fiat becomes, and the weaker the currency gets, the higher silver goes. There is no exit that saves both the banks and the money's purchasing power. That is why markets reacted that way. The bailout wasn't seen as strength, it was seen as surrender. It told investors the central bank will pick currency debasement over bank failure every single time. That realization changes behavior instantly. Once traders understand losses will be socialized and money printed to cover them, holding fiat becomes a risk. And when cash becomes a risk, capital seeks shelter elsewhere. This is how inflationary cycles begin. Not with announcements, but with forced decisions. The Fed didn't pick this path willingly. It was forced by leverage scarcity and timing. And now the market knows the new rule. If spot falls, the physical shortage remains. If spot rises, the Fed prints more. Either way, the pressure just builds. This is why the bailout wasn't the finale. It was the trigger that locked the system into a one-way dynamic. From here on, every move to stabilize creates more instability. Because you cannot solve a real scarcity problem with a printing press. Here, the market psychology finally breaks. For decades, the pattern held. Whenever silver rallied too fast, the shorts stepped in. They faded it, they dumped paper on the sell side. Spikes were crushed and rallies died young. That old reflex just broke. When silver mooned, this time shorts didn't attack. They ran, not by choice, but necessity. The math failed. The risk made no sense. Shorting silver stopped being a trade and looked like a suicide mission. This is what true capitulation looks like. When shorts exit the market, something dangerous happens. Liquidity dries up. The sellers who used to cap rallies are gone and price floats higher on modest buying. Moves get sharp. Gaps appear. Volatility rips upward instead of oscillating. This isn't a normal short squeeze. In a classic squeeze, shorts must buy back, causing a spike, then relief. This is different. It's a vacuum. Shorts have covered or stepped aside and nobody is willing to replace them. That creates a totally one-sided market. When spot rises and no one sells, every buyer pays up. Every deal happens at higher levels. This is how markets reprice, not gradually, but in massive jumps. The lack of shorts isn't bearish, it's a declaration of fear. It tells you risk managers checked the data and decided there is no safe way to bet against this rally. And once that realization spreads, it feeds on itself. New fiat enters. Old skeptics capitulate. Momentum kills disbelief. The suppressed asset becomes the chased asset. This is the phase where narratives flip. Silver stops being dismissed as a relic and starts being treated as protection. Not because of hype, but because the rigs that kept it down no longer function. When control moves from sellers to stackers, markets don't ask permission. They rip until a new equilibrium is forced. And that new equilibrium is always higher than anyone expects. This is where stress becomes visible, not through price alone, but behavior. In normal futures, contracts don't reach delivery. Traders roll them or settle in cash. That's how a paper system survives. But this market has stopped behaving normally. As silver surged, contracts weren't being rolled. They were held. Buyers stayed in the trade to expiration, demanding the warrant. That shift is critical. Trust in cash settlement is fading. They don't want exposure. They want possession. Physical delivery demand changes everything. When delivery rises, shorts lose time. Each contract becomes a countdown. Cash settlements are optional. Metal is not. And unlike fiat currency, physical supply cannot be expanded to meet the urgency. This is where paper leverage meets reality. Vault inventories that looked sufficient on reports suddenly appear thin when claims stack up. Registered metal becomes spoken for. Available supply shrinks, and once the paper market senses that delivery might fail, fear spreads faster than price. Because a market default is binary. If delivery succeeds, spot prices must rise to ration demand. If delivery fails, confidence in the rigged paper market collapses. Either outcome favors the holder of the real physical asset. This is why delivery data matters more than headlines. It shows intent. It reveals who is trading and who is securing supply. And right now, the signal is clear. Participants are choosing real metal over money. That choice marks a transition from financial stress to structural stress, from volatility to fragility. When enough players make that decision, the whole system cannot absorb it quietly. At that stage, paper markets don't unwind. They fully reset. At this stage, the idea that this remains a silver problem is an illusion. Markets built on leverage are never isolated. Stress travels fast. It moves through balance sheets, through collateral chains, through confidence itself. This is just how contagion begins. Silver was the trigger, not the destination. When a systemically important player struggles to meet obligations in one market, counterparties everywhere take notice. Margin requirements rise. Credit terms tighten. Liquidity that once flowed freely starts to really hesitate. And hesitation is surely enough. The modern financial system is a web of interconnected exposure. Positions are hedged with positions, collateralized with collateral, all layered on assumptions of stability. When just one assumption fails, pressure migrates instantly. This is why central banks react so quickly. They understand that a default in one corner does not stay there. A failed delivery or forced liquidation in metals doesn't end with metals. It cascades into rates, fiat currencies, and credit. The Fed's intervention wasn't about silver. It was about preventing that cascade, about stopping one crack from spreading into a huge fracture. But here is the problem. Contagion cannot be printed away. Liquidity can delay it. It cannot erase it. Every bailout shifts risk elsewhere, often into the fiat currency itself. That trade-off is now quite visible. As confidence in settlement weakens, participants demand higher margins. As margins rise, leverage falls. As leverage falls, asset prices reprice. This tightening happens not because policy demands it, but because broken trust does. This is the silent phase of crisis. No headlines, no panic, just subtle withdrawal, less lending, less risk, less tolerance today. And once that process starts, it feeds on itself now. Because systems built on confidence cannot function when confidence becomes very conditional. Silver didn't break the whole system. It fully revealed it. This is where the illusion of control finally collapses. The Federal Reserve stepped in to stop a fire, but in doing so, it locked itself into a trap with no clean exit. Every path forward now carries consequences they can't ever avoid. Here is the real dilemma. If the Fed stops intervening, stress returns immediately. Margin calls reappear. Liquidity freezes. Institutions already weakened face liquidation. That path risks a cascading failure the system cannot absorb now. But if the Fed continues intervening, the currency pays the big price. Printing money to stabilize leveraged institutions does not restore confidence. It transfers risk from balance sheets into the dollar itself. And once markets understand that trade-off behavior changes permanently now. This is the pivot no one even announced. The Fed can no longer fight inflation and protect the system at the same time. It has chosen protection. That choice signals to global capital that real value will be defended with debasement, not discipline now. And smart capital listens. When investors realize downside risk is capped by money creation, they stop hedging for deflation and start positioning for repricing. Cash becomes optional. Hard assets become strategic. This is not speculation. It is pure adaptation. That is why silver's move matters beyond its own market. It is exposing the limits of policy. It is forcing the central bank into reactive mode, and reactive policy is always behind the curve now. The Fed still has some tools. What it no longer has is any control. Once markets sense that they don't wait, they front-run the response. They move before policy acts, and when that happens, prices stop reflecting forecasts and start reflecting fear now. This is the final stage before repricing accelerates, the point where authority yields to math, where confidence yields to scarcity now. And from here, the system doesn't return to normal yet. It fully transitions. This is where everything converges. Strategy replaces speculation. Reaction gives way to positioning. What began as a market event has now become a lesson in how systems behave when leverage, scarcity, and policy collide here. The first lesson is simple. Systems don't break where people are looking. They break where assumptions live. For decades, the assumption was that paper markets could always be managed, that liquidity could always be injected, and that confidence could always be restored. That assumption is gone now. The second lesson is more uncomfortable. There are no painless solutions left. The Federal Reserve has shown its hand. When forced to choose, it will sacrifice currency stability to preserve institutional stability. That tells you exactly where risk is being pushed today. From this moment on, volatility is not a glitch. It is the feature. Hard tamps, sudden gaps, violent dips, followed by massive rips. This is real price discovery when the paper rigging breaks. If you expect calm, you are clinging to a fiat past that is already dead. So what is the play for a stacker? It means realizing that holding fiat cash is a losing bet. It means knowing that heavy physical metal acts nothing like paper contracts. It is getting your mind right for a market where spot prices move to ration the real supply, not to comfort the paper traders. The goal isn't to time every tamp or rip, it is to survive the fiat collapse and come out holding real value. That takes grit, steady hands, and the gut to ignore the FUD meant to shake you out of your physical position. History shows one thing. When currencies fail, purchasing power doesn't vanish. It shifts. It flows from those trusting the debt system to those holding real tangible assets. We are watching that shift kick off. This isn't fear-mongering, it is vigilance. It is seeing the rigged casino for what it is, not the lie they sell. These aren't random events, they are alarm bells, and alarms are useless if you don't secure your stack. If you found real value in this breakdown, subscribe to the channel so you do not miss the next move. Please like the video to help it find others who are trying to make sense of this great reset. And most importantly, comment below with your stacking goals, because the conversation is just beginning. The debt cycle is failing. The real money era has started. And those who stack the shiny early rarely regret it.